I was just looking at Roche, the big pharma. They own a company called Genentech. They also bought 𝗪𝗵𝗃's company. So I just wanted to check one thing for Roche, one of Switzerland's biggest companies. And one of the early biotech pioneers, not because they did any biotech science, but because they bought a company called Genentech. One of the most famous companies in American history. If you haven't read the Genentech story, there's actually, I think, an oral history of it. Let me see if that's true. Yeah, it looks like there is. California, Berkeley, or somebody did it. And this is actually pretty cool. It's a collection of oral histories with Chiron, Genentech, Amgen. So you can listen to some of these legends. Some of these guys are still alive, some of them are not. But there are 29 interviews here about the history of the biotech industry. This guy was the first venture capitalist. You may recognize his name as Kleiner Perkins. Used to be Kleiner Perkins Caulfield Byers. And now it's just Kleiner Perkins. They're the first really big VC. And they were the investor or co-founder, I think, I forget exactly, of Genentech. This guy has a famous story as well. There's a couple books about Genentech, actually. Herb Boyer was the co-founder of Genentech. Basically commercialized recombinant DNA for the first time for insulin. That's why we have human insulin. I just wanted to check this one thing and we'll jump into a couple stocks. Roche, let's just talk about the history of Roche and Genentech. Roche actually bought half of Genentech, then they bought the rest, then they IPO'd half, then they bought the rest. So they own all of it right now. But the issue with Roche is that really the entire company is basically Genentech now. It's weird because they have Swiss leadership. They probably should just have American leadership, but it's got a whole history that goes way back. And Roche is pretty well managed. They kind of missed out on like a lot of these companies basically were either haves or have-nots on GLP. And then there's like AbbVie, which did well on its own. But like in general, you either had a GLP, Lilly or Novo, or you didn't, and you underperformed. And Roche is catching up with their own GLP. You know, we'll see if Roche's GLP will get there. Everyone has one now. Roche is this weird thing where there's these bearer shares, Geissenschein or something like that. It just basically means bearer share, I think. Profit participating certificates, Geneschein. This is the annual IFRS report for Roche. IFRS is different from GAAP. There's no SEC filings for Roche. They only do international financial reporting standards. They don't do SEC GAAP. It's not an American company, so they don't need to file with the SEC. Net income has to converge to cash flow because over time, CapEx will stabilize as the business stabilizes, and the depreciation of CapEx will equal kind of the CapEx itself. So the CapEx dings cash flow, right? Because it's capital equipment, it comes out of cash, it doesn't come out of the income statement. So it comes out of the balance sheet. Depreciation, though, does come out of the income statement, but it doesn't come out of the balance sheet. So if those two things are out of whack, one will be preferred over the other. But over time, as long as CapEx kind of is reliable year over year, basically doesn't change wildly, they should approach each other. In biopharma, there's almost no CapEx in the first place. In software, there is no CapEx in the first place, generally. Some software businesses have CapEx, but not much. And so unless you go on this massive CapEx build, cash flow and net income are the same for most businesses, man. I guess I'm gonna do Disney. You know, the Godel, my Godel software, which I'm working on to compete with Bloomberg, is I'm writing Canadian stocks this week. I'm excited about that. Thank you for everyone for subscribing to Godel, first of all. We've had some pretty crazy growth. And don't be mean to me. If you're mean to me online, I'm very sensitive. I don't like that. You're gonna hurt my feelings, and I hate that. All right, I've never looked at Disney, so this will be fun. All right, let's look at some SEC filings. They changed the SEC.gov. All right, so we're gonna look at Disney. Each share of Disney is $85. I've never made a Disney model. I'm saving this to my GitHub, so you can follow along on GitHub if you learn how to use GitHub, or maybe you're a computer programmer already and you know how to use GitHub. So the first question I ask for a business is, how many shares are there? How many parts is this business divided into? Because otherwise the price means nothing. Some people look at a price like 1 penny and they're like, oh, it's only a penny, I can buy so many shares. Doesn't mean anything. How many shares are there? It's like saying, oh, I get a slice of pizza. Well, That's fine if the slice is the same normal size. You expect the slice to be a healthy size. But what if I told you that pizza was sliced into 200 million pieces and you're going to get one slice? You're going to say, well, it's not going to be very filling. And it's the same thing with socks. If there's only 4 slices of pizza in a whole pie, that's a pretty big slice actually. And if I say there's only 2 slices, well, you got a whole damn huge half the pizza. So it all depends on how many shares there are. And there's 1.8 billion shares. And I'm going to do this in millions. So it's 13 million, if that makes sense. It's the same thing as saying 1.8 billion, 13 million. So I know these are in millions. So 1.8 billion shares, and if I multiply these two, I get a $155 billion company. Why? Well, if each share is $86, and there's around 2 billion shares, so 80 times 2 is 160, it's a $160 billion company, roughly. So just 1% of Disney, let's say you inherited it, would be worth $1.6 billion, which is cool. It's a lot of money. It's a big company. There are bigger companies. Microsoft's worth $3 trillion. So 200 billion or 150 billion isn't what it used to be. So now I'm going to look at the financial statements. And learning how to look at financial statements is pretty important. It's not the only thing you have to do, by the way. Some people get confused when they look at my lessons and they're like, oh, Martin, you teach financial statements, that's so basic. Well, you got to start somewhere. And a lot of people never get to look at financial statements in the first place. But I don't want to give anyone the illusion that the only thing you ever have to do is interpret financial statements. You also have to forecast financial statements and do due diligence in a variety of ways. It's not easy. In fact, it takes a lifetime of different skill. You learn things, you pick up things, you discard things, you forget things, you make mistakes. It's certainly not easy. Okay, so the first financial statement we're going to look at is called the income statement. That's where most of the action is, quite frankly. A lot of people only look at the income statement. That's probably a mistake, but regardless. So basically, Disney generated $23 billion of revenue. What does that mean? They sold $23 billion of products in Q2. Q2 is what, April through June. 90 days. So 90 days, they sold $23 billion of products. Wow, kind of amazing, huh? And we're going to go into, well, what are those products? Right here, it just says services and products. Not that descriptive, right? I don't wish I was 𝗨𝗏𝗘𝗧. I'm way, way bigger than 𝗨𝗏𝗘𝗧. Stop it. I'm a professional. I'm not a, I don't need to, I mean, I watched that guy stream the last time he streamed just because I was curious. He acted like a complete crackhead. Could you imagine behaving like that? I'm a professional. Okay, anyway, I don't know who this guy thinks he is. So they don't have, this isn't too descriptive, right? Services and products, pretty vague, right? So now I'm gonna add these two numbers here, and we're just gonna call that cost of goods. And that basically means what did it cost to make the product? And that includes people, which I didn't realize that until a few years into my financial career, which is about 20 years ago. But it's not just the materials costs of the products, but it's also the people costs. Because sometimes it costs, like in Disney's case, they have to pay actors. And actors are part of the cost of goods. The goods may be a film or a TV show. Okay, Disney is a pretty diverse company. It's the biggest media company in the world. Okay, so now they have something called selling, general, and administrative. Well, selling is like marketing costs. General and administrative is what it sounds like. It's just a kind of a catch-all. It could be lawyers, financial people, tax people, auditors, you know, everything and anything under the sun. Insurance is actually a big expense for a lot of businesses. They put depreciation in their income statement. I'm going to exclude it. And I'm just going to go to operating income. So we start off with revenue. I hope you guys can see this. And we subtract the cost of goods. So they generated $23 billion in revenue. They sold $23 billion of stuff. It cost them $15 billion to make that stuff. So after that, they had $8 billion. Does that make sense? 23 minus 15 is 8. And so I look at that ratio, everyone looks at that ratio, it's called gross margin, or gross margin percentage, some people call it. I use these terms. I use gross margin to mean what percentage of revenue is left after the cost of the product. And it's 36%, pretty low gross margin compared to other big businesses. And then I call gross profit the actual dollar amount left over, which in this case is more than $8 billion. I do the same thing with operating income where, okay, it costs $4 billion to run the business and we had $8 billion left after the cost of goods. So now we have $4.5 billion left after everything. And we're at a margin for that too. And just as it's operating income, we're gonna call it operating margin. And we're gonna see it's around 20%, which is a little bit better. So Disney has the disadvantage of the products cost a lot of money to make. But they have the advantage of it doesn't seem to cost that much money to promote or run their business. So it's kind of a trade-off. A lot of other companies, their product doesn't cost very much to make, like software, but all the other stuff costs a lot, promotion and development of the product and stuff like that. So Disney's got a little bit different of a model there. Okay, then there's like interest and like some other like little things. Some of the stuff distorts the true picture, some of it doesn't. Gotta love Disney paying $200 million in taxes, only like 5% tax rate. Did you guys pay 5% taxes? No? Okay, it's more like 10%, but regardless. All right, so after taxes, they generated $4 billion of net income. Now, does this mean they generated $4 billion of cash? Anybody know? Chat? Anybody know? Not necessarily. That's why we have the cash flow statement. This is called GAAP accounting. And GAAP accounting is complicated. And it doesn't necessarily always reflect reality. Usually does, not always. This statement's called the balance sheet. So the balance sheet is just an accounting of every, really what's called account balances. And that's sort of accounting jargon. What it really means is, what are all the assets and liabilities of the company? And in this case, they have cash of $5 billion. They have accounts receivable of $13 billion. Accounts receivable is cash you haven't received yet from your customer. Your customer owes you money, and you got to collect. So that's $13 billion. That's pretty close to cash. And the balance sheet is actually listed in order of cash, in order of liquidity. So accounts receivable is very likely to turn into cash. Inventories are a little different. Inventories are products that you're making or you've made. And so inventories are not necessarily going to turn into cash quickly. You're hoping you're going to sell them and turn them into cash, but you may not. All right, they have an asset called content advances. So I guess they've given advances to content creators and they're expecting to get content back. So that's an asset. And they have other. And now there's more produced and licensed content costs. I kind of want to lump this with content advances. But so basically assets are, they have $32 billion of content. And, you know, it'll be interesting to see how they make this determination of how much it is. Netflix has the same problem where it's like not really clear what assets the company actually has and like how their business really works, but that's life. The most important, one of the most important things I'd say in the balance sheet is property, plant, and equipment. So you could also call content like intellectual property, arguably. PP&E is property, plant, and equipment, and these are assets that are sometimes called CapEx in a different context, but they're basically capital goods, so their useful life is more than a year. So they have to be depreciated over their useful life. So an amusement park attraction could be a 10-year useful life or 20-year useful life. A building could be 50 years. A computer is like 3 years. So you have to depreciate the cost over time. You don't just take the cost out right away. And any plant or equipment works that way. Let's see. So it's actually 36041. Now we have goodwill, which is kind of an accounting thing, which is not that important. We have more goodwill than that. Disney sort of built itself up by acquisitions over time. Started off as an animation thing, obviously. One more line called other. Okay, so $98 billion of assets. Some of these assets are fake, so like goodwill is not really an asset. So we sometimes say the tangible book value is 112 billion without the goodwill. Something to keep in mind. Goodwill isn't really an asset. And if you're interested in goodwill and why it comes about in accounting, there's a very good reason why, but you probably want to take an accounting class or something like that. It basically is there to force the balance sheet to match. And again, you know, there's a lot of stuff there that maybe I can explain in another video. It's really not that important right now though. All right, accounts payable, 20 billion. So this is money they owe vendors. So when you buy a bunch of stuff from a big company, they don't necessarily want cash on delivery. They may, like, for example, McKinsey might do consulting services for you, and they bill you $2 million. They're not going to be like, no, I need the cash up front or something like that. So it's on credit. And Disney's got obviously very good credit. So accounts payable, they're 20 billion. Debt. So Disney's borrowed money to buy companies, and they borrowed a lot. They have 48 billion in debt and 10 billion in cash. So I'm going to mark that down here. 10 billion in cash and 48 billion in debt. So the enterprise value is 192 billion. And if you don't understand that concept, it's really important. And basically the idea is that if you buy all the shares of the company, or even a few shares of the company, you get the cash that comes with the company, but you also get the debt that comes with the company. Doesn't mean you owe it personally, of course, but you have to consider the fact that if you buy a company with a huge amount of debt, that company still owes that debt, and it has to pay that debt before it can pay you. So you have to include that in the enterprise value. So the enterprise value of Disney is actually 192 billion, which is more than the market cap of 155 billion. And that matters. That's significant enough that it's going to affect their calculations. Okay, deferred income taxes. Some of the stuff, again, is accounting gobbledygook. And there's abbreviations for this stuff that you learn over time. And if you've taken an accounting class, you know that the balance sheet has to balance because the liabilities plus the stockholders' equity has to equal assets. And of course, it is not equaling because I must have made a mistake somewhere and forgotten something, which is fine. I can go back and see what it is I forgot. Aha! I forgot deferred revenue. Deferred revenue is product it's product you've received money for, but you haven't actually delivered the full product yet. And that happens a lot in software. Okay, now we see the liabilities and stockholder equity matches the assets. Good. Okay, so what do we do now? Well, I want to look at the cash flow statement really briefly. I'm going to do an abridged cash flow statement. I'm just going to do cash flow from operations. This is actually a 9-month number, which is a little annoying. So Disney's on a weird like calendar quarter. So I'm going to actually erase all these and change this to just 6/29/24, and this is like probably some weird calendar quarter, which we'll get to in a second. Usually April to June is called Q2. In Disney's world, it is not. So the cash flow from operations was around 9 billion for 3 quarters, which is interesting because just for this one quarter, it was 4 billion. So we have to look at a couple more quarters to see. But let's just go to Disney's investor relations site too, because what I want to see is their earnings reports. So here's their earnings report, and this is also called a press release. And you should be able to find this on Bloomberg or Godel. If you can't find it, there it's rare. But here, for example, is, let's see, what date was this? August 7th. So here's, August 7th, Disney reports third quarter and 9 months earnings for the quarter. And here it is on Godel. And it's the same thing that you would report. And that's what's called a newswire, or the press releases. And the press releases for the company are really important because they're the sole official statements of the company. And those are really critical to follow really carefully. And that's why you can pull them up on Godel. If you try to pull them up on Yahoo Finance, this stuff all looks like ads. Like this is a literal ad, which I clearly don't want. And if I'm looking for the actual company press release, it's like all this garbage from different random places like Motley Fool and like, I just need the quarterly press release, man. That's the important thing. That's the official company numbers that I can actually sink my teeth into. And instead, I'm getting all this nonsense. And I'm like, see all these other ads and I'm scrolling and it's like, where is this thing? And in fact, I probably am going to be scrolling a lot before I see, okay, there's the actual conference call, and finally, maybe a press release. Yeah, this is just like a bunch of trash thrown in. Okay, there it is, finally. You know, you can use this. Oh, and here you can actually click press releases, which is a little faster, I guess. But like, you still have these ads and all this garbage. So like, that's why professionals don't use Yahoo Finance and you use the terminal. Okay, so I'd like to read the press release because I just want to know what it is that the company is saying about their business. So this is Q3 24, fiscal Q3 24. So normally Q3 is you know, it's July, August, and September, but for Disney, it's April, May, and June. Okay. I'd like to maybe first see, so the CEO is Bob Iger, who's a pretty famous CEO. He actually wrote a book recently. And he's been like trying to retire from Disney for like a zillion million years and still hasn't been able to do it. Okay, so Disney, it looks like, I'm going to put in the quarter from last year. And it looks like if you compare new divided by old -1, you can see that the company grew 4%, which is why it's a little weird. Like they keep, in the press release, they're sort of talking about growing faster than that. But a lot of these companies try to spin it as best as they can. And so here's the company breakdown. And you can learn a lot just from stuff like this. Even if you never invest $1, it's actually kind of cool to learn your industry. Let's say you're in the media industry. Well, this is the biggest media company. So knowing how they're doing is going to be really important for you to understand your business. So entertainment is their biggest area or sector, and that's about half their revenue. And obviously, we have to see how they define entertainment. It's probably television and film. Sports is a smaller business for them. It's about 20% of their company. And experiences, that's the theme park. And so that's grown a little bit as well. Actually, each of their businesses grew, but really slowly. And they actually have operating income for each segment. I'm just going to jot that down here because I'm kind of curious. And I should be able to look at gross margin or operating margin for each division. So it looks like parks is the most profitable division. And I guess if you've ever been to Disneyland, you understand why. And film, like TV and film, is not very profitable. In fact, it looks like they're breaking even on that. And that probably could be due to Disney Plus. But it's something that's interesting. I think quantitative investing is pretty cool. Or at least, I wouldn't say maybe cool, but it could be a great career for the right person. It's not great, let's say, for me, because like I know what I like, and I like the interesting, rich tapestry of business. And if you just like looking at lots of data, that's maybe a little more, your speed. Okay. So Disney Plus, I guess, so this is the breakdown of entertainment. Linear networks is ABC, stuff like that, I think. And linear networks is actually down, which makes sense. Television's kind of dead, right? Direct to consumer, I think that's a combination of film and streaming. But I could be wrong. And then content sales and licensing. And so this is what makes up entertainment. Very interesting. How do you decide if a company is overvalued or undervalued? It's really hard. That's the short answer. And it's a little bit of art, a little bit of science. So I guess ESPN is a linear network. Okay, here's Disney Plus. And that is direct to consumer. So Disney Plus, they had 54.8 million subs, up from 54. International, they actually had a small downtick. Disney Plus total. Then there's Disney Plus Hotstar, which who knows what that is. And then there's Hulu. Star India, I guess, is another thing for them. That's really it. It's ESPN and Star India. They include consumer products in there, but it's mostly parks. Streaming was up 15%. So I guess the whole bet is on streaming. And so we basically looked at a quarter of the company, very cursory, like we should read this with a fine-tooth comb, and we should listen to the conference call. If you haven't listened to investor conference calls, it's pretty critical that you do that. It's kind of interesting when big companies like Disney talk about the economy. It's almost as important as the official like government like economic numbers. Because if Disney is telling you there's a slowdown in business, it's like a pretty good barometer, right, for the rest of the world or the rest of the economy. So if a huge company like that is saying, well, we're seeing a lot of slowdown, there's a lot of issues, that we're concerned about they have a different kind of press release. That's cringe. Like it says revenue and costs and expenses. So there's no actual true income statement. So I guess I can just go to the SEC filing. But anyway, sometimes you can get some color on the global economy by just kind of like listening to the major companies, Disney, Intel. Like you get this like sense for like, okay, are we in a recession or not? Because like if Disney's growing 4%, economy can't be that great. Now maybe that's just a Disney problem, but then you look at another company and you see the same thing, and they'll have this very like muted attitude where they're like, yeah, things are all right. They're not like they were 2 years ago or 3 years ago. Things are really good. And you can kind of get a sense for things like that. So just something to kind of keep in mind. And there are actually a bunch of surveys that do that job as well. It's Michigan survey. Okay, so here's another quarter, and it's like super easy to just copy and paste the formulas and stuff like that. So you only have to put in a couple numbers, basically. If you think this looks tedious, then Wall Street's not for you. Investing's not for you. Investing is tedious. It's like, what investing's like? It's like going to a garage sale, which I don't do or ever have done really. But it's like if you were going to a garage sale and you're like picking out like the best bargain of the entire garage sale. And you're just like sitting there looking over every single stupid trinket at the garage sale. And you're like, maybe this is cheap. And then you finally find like some awesome thing. And you're like, wow, I got a great bargain. That's basically what it's like. And this is like a systematic process. I've basically taught, I can't take all the credit for it, but I think a lot of Wall Street has actually systematically used my approach, which is really flattering. It's an approach of cataloging all of those items at the garage sale. All right, let's look at Disney a little bit closer. I want to look at the annuals. The fourth quarter ends, I'm guessing 9/30. And I'd be curious what Nelson Peltz's problem is with Disney. Because like, I look at this as an outsider and it's a lot of growth. And I'm guessing it's a lot of growth without a lot of earnings. But 22% growth and 7% growth for kind of a small company. I'm sorry, a huge company. Yeah, pretty impressive, actually. Not easy to grow. Like, media is a very mature business. Like, it's kind of hard to grow in media. What is there new in media? And they missed the whole like streamer, Mr. Beast type of thing because they couldn't really get involved in that. They couldn't create like that. They should have somehow like helped creators really take advantage of YouTube and TikTok, but they probably viewed them as competitors and they just kind of like were stupid about the whole thing. So like the one part of media that's been growing, streaming, is something Disney completely missed. Trying to get into streaming of their own content, of course, that's what Disney Plus is, that's why they're growing. So when I say streaming, I don't mean streaming technology. I mean more like the creator economy type stuff. The Aiden Rosses, Mr. Beasts, Andrew Tates, that's all media too. And so media is, basically what they whiffed on. Why isn't there an Andrew Tate ride at Disneyland? Or maybe more realistically, I don't know, Charlie D'Amelio or like one of those other. Disney's also never, I do believe they were in music at some point and then they sold their music business. That I think has grown better than film and TV. And then also video games. And I think they also had a video game business and they sold that too to focus in on just parks and this stuff. But hey, earnings look like they've been growing too. I think the stock has been a dog, but I don't know why. Sometimes you can't force a stock to go up. You just gotta wait. It's one of the key things I learned on Wall Street. Just wait, man. It's not the end of the world to wait a little, The stock's not dropping like a rock. Sometimes it's honestly a good thing if you really have a lot of conviction. Now, a lot of people, they want to make money instantly because this concept of IRR is very important. internal rate of return. It's critical. You want to make money as fast as possible. But, you know, it's not that easy. You can't always expect when exactly your stock's going to rise. And if you expect it to rise as soon as you buy, I have news for you. It's not going to work all the time. And you should just be happy that it's going to rise eventually. Now, some people have, you know, they're professional investors. They need their stocks to go up kind of as soon as possible because of their, you know, have investors and things like that. But if you are a corporation or someone like Warren Buffett, which is basically a corporation, let's get back to work. So cash flow for Disney has also gone up a lot. And if you notice, like, so they made $6 billion in cash flow, tips, donations, sales, I mean, they're all the same thing. But I'm gonna look at CapEx too, and their CapEx is huge. Now I see what Nelson's mad about. All right, so free cash flow, which is cash flow minus CapEx, it was 2 billion, then 1 billion, then 5 billion. 215. It's that simple. And the company's worth 190. I'm curious what the, so you might be asking, what am I doing? I'm curious what the peak cash flow of Disney was. So like, some companies do have to go through this like reinvestment period, but I don't think Disney has lost like the value of their assets. If anything, it's like kind of gone up. So like, I'm curious, like after this like transformation is done, like what can they get back to, or even more maybe, if that makes sense. So, and again, I'm not God's gift to investing in every sector. Like I know enough about investing that I can look at Disney, but it really helps when you've been looking at that sector for like ever, right? I've been looking at drug stocks forever. Like I know everything about drug stocks. So I know every trick in the book. I know what to expect. Like that makes my life a lot easier when I look at a drug stock. But when I look at a media stock, well, I don't really know what I'm looking at. You know, because I haven't looked at media stocks forever. I know what an income statement is. I know what a balance sheet is. I know what cash flow is. I know what growth is. I know a lot of the same themes, but I don't know the media space. Like I don't know what, you know, what do they call when all those ads happen, the ad sales happen, sweeps week or something like that? So it's something to think about. It does look like Disney had higher cash flow at one point. So at one point, Disney had 12 billion in cash flow. Isn't that crazy? And then 14 billion. And they basically said, okay, we're gonna do streaming and it's gonna be this like long-term investment that's gonna pay off. And since then, okay, so at some point they were making around 10 billion in free cash flow. So what's the upside here? So let's say they get back to that. This is short, man. So maybe they get back to 10 billion in free cash flow, and you're paying 20 times enterprise value for a dead media company. Look, they got great brands and everything, Star Wars, ESPN, whatever, but I think they're out of touch. They may be out of touch. Some of the stuff is like, I don't know, a lot of these assets aren't that excited by Bob Iger value. I don't know, my cursory look at Disney is this is decent short. I'm not sure they'll ever get back to that. They have good assets, but the more they try to extract out of them, the more they hurt.